Dear viewers and esteemed colleagues from the financial services industry, welcome to today's webinar, Introduction to Fundraising, Part 1, provided to you by Advinda in cooperation with DC Placement Advisors. This webinar is part of a 3-webinar series, and your speakers for this include Eva March, CEO and founder of Advinda Investor Cloud, and myself, Stefan Dickhoff, Vice President at DC Placement Advisors. This webinar is all about qualifying an investment manager and fund for success with the institutional investor market. For clarification purposes, in this webinar, we will use the following terms to refer to, on the one hand, investment managers, and on the other hand, investors, respectively. Investment managers are general partners, or simply GPs. Investors are limited partners, or simply LPs. For those viewers that are new to the universe of managing institutional funds, please note that GP and LP are also the standard terms that are broadly used to refer to the investment manager and investor, respectively. Takeaways from this webinar that you can expect include, firstly, an overview of today's institutional investor fundraising market. Secondly, a tutorial on manager selection performed by institutional investors. And thirdly, an introduction into key consideration for GPs when preparing a fundraising concept. This webinar includes the following topics. Firstly, fundraising today, including an overview of the fundraising market and what it means for investors to qualify. Secondly, manager selection, including how investors assess a strategy and investment product, factors that influence the universe of potential investors for an investment product, how investors evaluate the fund's terms and conditions and the fund structure, track record evaluation, how to present the investment opportunity to LPs, placement routes, including target investor mapping, i.e. the who and the how much, process and timing considerations, how to make the fundraising process efficient, and fourthly, key considerations for successful pitches and selling. That is, how to make a selling pitch, what tools to use, and who else can help. Specifically for today, we will focus on fundraising today and, from manager selection, how investors assess a strategy and investment product, and factors that influence the universe of potential investors for an investment product. So, as for the first part of today's webinar, fundraising today. Now, first, we will give you an overview of the fundraising market. And secondly, we will discuss the probably most important part of the entire fundraising campaign for the investment manager. That is how to get the foot into the door of the institutional investors. And that is what it means to qualify with investors for investors. Now, fundraising today. Firstly, it is to be noted that the institutional investor fundraising market is a two-edged sword. On the one hand, institutional investors usually have significantly more investment capacity than retail investors. However, the institutional fundraising market is also very complex. Thus, investors consist of different types, including, for example, pensions, insurance companies on the very prominent side, and then also family offices, church investors, private banks, etc. Several of those types, which are also covered, amongst others, by centralized investment centers or investment consultants. As a second consideration, you have different countries with different regulations. Thus, investors from different countries may be in a different way restricted or required for certain type of investments. And thirdly, And very importantly, for those seeking capital, different investor types from different countries have different sizes of pockets from which they can invest into investment products. The conclusion is, for a GP aiming to raise capital from that market, having investor contact information ready is only one part of the equation. For those seeking capital from investors, a roadmap to fundraising is needed. That roadmap is for the preparation. And in the preparation towards fundraising, one must determine the how, the when, and, very importantly, the who of the fundraising campaign. Because after all, investors must be approached in the right way, at the right time, and very importantly, one must be efficient in the selection of potential LPs to be contacted. Covering the whole universe of institutional investors in a proper way is impossible. At the same time, using an inadequate selection criterion for who to contact also defeats the purpose. Due to their investment capacity compared to retail investors, institutional investors are approached with a multitude of investment opportunities. Many of those products are investment funds with familiar strategies and by well-known GPs. However, increasingly, investment opportunities are offered by GPs that are rather unheard of by the institutional investor market and with new investment strategies. Along the way of fundraising, no GP will receive capital subscriptions from all approached investors. As a result, on average, not more than round about 1% of institutional investors that are contacted actually end up investing into the investment product. Notably, that 1% only counts for investment products that are deemed to be qualified by the investor. Also, that 1% usually has undergone an often lengthy and sometimes very cumbersome due diligence process by the investor. Therefore, accessing the institutional investor market is a challenge, but it is a challenge worthwhile. In order to tackle the challenge, EGP must be knowledgeable about the positioning of its offering vis-à-vis the market. Successful fundraising is eventually the result of that knowledge in combination with intelligence about its target investor base and the nuances of their decision-making process. Advinda provides you with the investor intelligence, and this webinar gives you an introduction into manager selection and how to best use the investor intelligence. In order to become approved for an investment by an institutional investors, investors make some generic considerations as well as several individual considerations. Broadly speaking, the generic considerations conclude in the assessment of the institutional quality of the GP and the overall investment product. That is, it answers the question, is the GP and the investment product eligible for committing third-party capital to? Or in other words, can the GP invest other people's money? Having said that, institutional quality can also be graded. And here we want to give you a few generic considerations that the LP applies in this grading process. So firstly, although there is this grading, it's important to know that there is no assessment that all investors use to determine institutional quality. So there's no one for all concept or methodology. Having said that, a minimum level of quality needs to be achieved or established in the assessment by the LP, otherwise the investment product will no longer be considered. Now, several factors impact the exact quality assessment. That is, including others, the level of investor sophistication, for obvious reasons, more sophisticated investors will take more factors into account. Then secondly, general considerations. For example, has the GP managed other people's money in the past? And thirdly, subjective assessment takes also an important role. Now, more specifically, when talking about subjective considerations, institutional investors determine institutional quality based on, amongst others, investment opportunities, specific demands of the investor, which of course is very tailored. Thus, it can be the return requirement, it can be the demand to only invest into GPs that have already managed a couple of funds in the past, or various others. Then there are requirements and preferences, partially interlinked to the specific demands, but then also requirements such as from a regulatory standpoint. And finally, investment allocation plans. Now, when you as a GP approach the market, investors will look at you and your investment products in terms of, amongst others, the asset classes, the track record of you as a GP and of you individually, the investment strategy, the return profile, the fees and expenses, the risk profile, and the team and organizational setup. Therefore, key questions GPs have to ask themselves to reconcile the assessment that the LPs will do include: how do I assess the quality of my fund? What do I need to consider for specific types and geographies? What do I need to consider throughout the process? And most importantly, how do I prepare to stand out with a potential LP? Now, as for the second part of today's webinar, the topic of manager selection, clearly the most important part that the GP has to focus on before selling its fund product. And here the key questions, or rather considerations, that a GP has to make include: firstly, how investors assess a strategy and investment product, and secondly, the factors that influence the universe of potential investors for an investment product. Other factors we will discuss in the next webinar. Now, for the answer to the question of whether a strategy and product fit institutional investor demands, several generic components are considered, as elaborated before. On the strategy side, there are the asset class. So, for example, are we talking about a company? Are we talking about a currency? Are we talking about aircrafts, real estate, whatever? The asset class is an important consideration. Then next, do we buy debt, equity, or a hybrid such as equity with debt-like features? Next, target criteria. So what are the selection criteria based on which investments will be selected for the fund? That includes, amongst several other factors, the target size of the asset, of the investment, as well as the geography in which investments shall be made. Linked to this also the experience by the GP in the target geography. Next, the investment situations that are being focused on. So are we looking at performing, distressed, opportunistic strategy? And again, linked to the last point, opportunistic, how well does the GP define what investments they want to do and how much freedom do they need in their investment strategy in order to make opportunistic investments? As a fifth point, the sourcing strategy. So coming back to the target geography, for example, does the GP have the capacities in place to source investments in their target region? Do they rely on active or passive sourcing? So several factors which then determine the ability of the GP to deploy at the end of the day. Then generic components about the product, that is the fund, include firstly the GP, or in other words, the investment advisor. That includes the team, the organizational setup, that is the organizational setup of the GP, where the employer, the firm where it works, so the key entity that is managing the fund, the transparency of that organization, of the ownership of that GP, etc. And secondly, the investment and monitoring capabilities. Thirdly, portfolio at commitment. So that is, does the product already offer a portfolio on day one? For example, via a seed portfolio or a portfolio that can be bought through a secondary transaction. In addition to this, the expected deployment period, or also called ramp-up period, is a key consideration. Otherwise, investors are afraid that their cash will lie idle when it could have also been invested with somebody else. As a fourth point, the existing track record in that strategy. Has the GP done investment in that field before? As a fifth point, terms and conditions, for example, pricing as a key point. Also, liquidity and the term of the fund product are key considerations. Then, increasingly important is the ESG framework in place. ESG means, does the GP have an ESG policy in place? And then also through their investments, do they consistently and coherently comply with ESG standards? In that respect, it is also noteworthy that several institutions, including amongst others also the European Commission, are implementing several new rules and standards that GPs and fund products are expected to abide to, or at least standards that will determine whether certain type of LPs, like insurance companies or pension funds, are allowed to invest in those investment products. Then next, the type of investment vehicle. Particularly for commingled funds, it is noteworthy that the required passporting, or as a more general note, the licenses and regulations that need to be complied with in order to market the fund product throughout Europe is a key issue. And the Alternative Investment Fund Management Directory, the AIFMD, is a key standard in that sense, as it allows GPs to market their fund product throughout Europe. Other considerations about the product include, for example, external parties and audit and external valuations. Now, to continue on the previously mentioned generic considerations, in order to size the market of investor demand, a few key considerations include the return requirements by the LPs. So naturally, an LP will deselect investment products that do not fit within their return requirements. Thus, the higher the target or expected return, the broader the number of LPs and LP pockets the investment product can access. Secondly, macro developments. So this is a point which changes over time, but as macro developments change and the overall perceived positioning changes, the more investors will move into certain investment product categories. Next, structure and regulatory considerations. Now, the structure allows the eligibility for certain products, and likewise the regulatory considerations. So to give an example, the solvency ratios have an important impact on the possibility of an investment product to be allocated by larger institutional investors into certain categories. And these categories in turn have maximum percentages which are provided by the regulator in certain countries. So if you fit within the solvency and quota requirements of an asset class or strategy which has a bigger allowed share in the portfolio of the LPs, that also increases the possible demand by those very large institutional investors. And as a final and very related generic consideration that drives investor demand, there is the asset allocation, and that is including the classes and the subclasses of the asset strategy. Now, investors for which those filters are passed will then select investment products based on an in-depth fund selection process, also called due diligence. And therefore, as the most important first step of this tutorial, and that goes for the preparation of the fundraising material, but then also for the strategy of the fundraising, that is whom to approach and when to approach those individual LPs, it is important for the GP to take a step back and analyze the own investment offering very self-critically. And the structure by which we propose to do this is by the means of a SWOT analysis. That is analyzing the strengths, the weaknesses, the opportunities, and the threats. Now, it's understood that this is usually a very challenging task, as it requires the GP to take on the perspective of a so-called devil's advocate on himself and on the opportunity. But it is a crucial first step. And with that in mind, strengths and weaknesses should be considered from a fundraising point of view. As one of the several elements of a fundraising analysis, one should keep in mind that what is an attractive investment for a sophisticated investor who is already familiar with the GP and the strategy may only attract a relatively small amount of larger institutional investors, as it is an unacceptable proposition for them. To give you one example, hedge funds, in particular very specialist hedge fund strategies, may be very attractive for hedge fund investors. However, several larger pension funds simply do not invest in hedge fund strategies anymore. Now, key considerations of the SWOT analysis include the investment strategy, the institutionalization of the GP, which goes back to the institutional quality of the GP, then pricing and other terms, the track record of the GP, and investment opportunities. While you go through this analysis, keep in mind that at this stage you're addressing the institutional investor market, and they tend to look at fund offerings in a different way from retail investors. Now in the following, let's go through each of these factors separately. Does the investment strategy meet investor appetite and target allocations of institutional investors? As part of this first point, one must look at the following factors. Firstly, the asset class or the asset classes for the target investments. Then the nichiness of the investment strategy. For example, whether only one geography or industry is targeted. Then the market for investment opportunities. That means the underlying market that defines the opportunity set for investments to be made by the fund. And finally, the level of complexity behind the value thesis of the investment strategy. And target return. Now, a few general rules that increase the institutional investor demand. Institutional investor demand increases with the level of investor familiarity with the strategy. And then it increases with the market of investment opportunities. And it increases with the positive track record of the strategy in investment history. So, for example, the US subprime market likely finds less investor demand than, let's say, for example, the performing direct lending strategy. Now, for the track record of the strategy, it is also to be noted that there is a trade-off for some newer strategies that are unproven versus those strategies that already are established and which may have a mixed track record. However, there is simply no clear point to make on this. So investors generally are likely to be more favorable towards a strategy with a long track record for which they can establish their expectations in comparison to a newer strategy. In addition, broad institutional investor demand increases with the lack of complexity and the lack of nichiness of the strategy, as this will always have to focus on a smaller subset of investment opportunities. General overarching factors that determine the size of the approachable investor market further include the riskiness of the strategy. That is, what is the expected loss ratio of a strategy, and in consideration of that loss ratio, does it perform well in only one market cycle, or is it less dependent on an up market versus a down market? As a rule, most investors will exclude investment opportunities with a certain level of risk, especially if it cannot be adjusted for by a higher return. And in addition to this, even besides the potentially higher level of return, for many investors, the screening of an opportunity stops once the risk profile of an investment opportunity is considered as too high. Now, next, time horizon and duration. So how long is investor capital tied up for? And indeed, in the sense of fixed income investors, what is the sensitivity to changes in the yield curve? A key reason why this matters is that, for example, many insurance companies or also defined benefit plans have to match their liabilities with their investment strategy. Next, the liquidity profile. So does the investment product provide a cash yield or regular distributions? And does it satisfy solvency requirements by larger institutional investors? And finally, as a very obvious point, the minimum investor commitment. So this minimum amount that an investor must commit to an investment product determines what investment capacity the investor must have in order to commit to the fund product. So thank you very much for watching this part of the webinar series. We hope that it gave you a good intro. And before we leave you today, we would like to wrap up the key parts that we discussed today and what you can expect from the next webinar sessions. So firstly, we gave you an overview of the institutional fundraising market environment and established that it is very complex, that it is difficult to source money from LPs globally, and that on that basis it is very, very important to be prepared and also determine who to approach, when to approach, and how to approach LPs. And because this is a very fundamental issue, we will be covering this in the third session of this webinar series. And then secondly, as another point of the preparation, the GP must assess the investment opportunity from the eyes of the institutional investor. And for this, we will give you an introduction into some of the key parts of the analysis and some of the key parts that the GP can prepare himself in the next session of this webinar series.